Set the odds the way the market set them before the opening bell. The options priced a two-way swing of about 0.7% for the day, and the desks were leaning on one outcome, a friendly inflation number carrying the S&P in a quick run at 7,800. This is the Algo Index market close for Wednesday, the 12th of August. The number arrived, and it arrived friendly, in line on every single line. So here is what the market did with a green light it had spent a full week waiting for. It gained 0.25%. It jumped in the first hour, stopped more than 30 points short of that 7,800 ceiling, and then spent the next 6 hours quietly returning the jump. The only thing that moved with any conviction was the fear gauge, and it moved the wrong way for a rally that size, down almost 5%, the loudest single reading on the entire board. 3 questions carry the rest of this show. 1. How does a market that got exactly the number it wanted travel only 0.25%? And why did $7 billion of hedging flow pass through the day and change almost nothing? 2. Where did that first hour jump die? And what makes the wall above it the one line this whole story turns on? 3. Which single stock swallowed a $20 billion overhang today and walked straight up through its own ceiling? After those, the desk result and the road into a second inflation number before sunrise. Start the board with the number that barely changed and the one that changed the most. The S&P closed at 77.48, higher by 0.25%, with the Nasdaq 100 up 0.75 and the Dow a hair lower, one of the narrowest full sessions of the month, at 36 basis points top to bottom. The number that actually moved was fear. The volatility gauge dropped almost 5% to 14.5. Its companion future swings measure eased to about 88, and all of the event premium that had been sitting in the options for a week came out at once on the release. Now the reading that tells you the day was smaller than the buildup. The options had priced a move of about 0.7%, and the market delivered around 0.36. It realized roughly half of what it had charged for, which is the fingerprint of an event that was fully anticipated and then simply absorbed. Protection prices agree. 1-month volatility rank sits near the bottom of its own year, so options are cheap against how much this market has actually been moving. Here is the piece your screen never plotted, and it is the whole reason a green light produced a gray day. Our real-time read of dealer hedging did not sit still today. It swung from about $3 billion negative to $4 billion positive, and back to $1.5 billion negative. A $7 billion round trip across the session. And it moved price almost nowhere. Large flow going in both directions and being absorbed without expanding the range is exactly what a dampened, positively positioned market looks like from the inside. The mechanics behind that calm setup tomorrow. When the inflation print released the event premium, fixed strike volatility fell across the book. Falling volatility with a rising index shrinks the value of the downside puts that dealers are short. So to stay hedged, they have to buy back the futures they were holding as insurance. That is a quiet, mechanical bid that feeds on itself as the market lifts. And it is why a positively positioned market can drift upward for days after a volatility crush. It has one off switch, and its name is a hot producer number tomorrow. So what did the lifting, since it plainly was not the whole market? Leadership was one theme only: artificial intelligence hardware. The memory group rose about 8%. One server maker gained 19%, and the largest chip maker added 3%, while a software giant and a social media name each fell more than 2%. And the market waved off 2 warnings. The 10-year yield refused to rally on a friendly number, and a shut Strait of Hormuz priced at 0, even as crude slipped. Pull up the day in its actual shape, because it draws cleanly. The benign print gapped the S&P up, and the first cash hour did all the buying it had in it, printing the session high near 77.66 and never getting back there. From that high, it was a slow, patient giveback. A higher low near the middle of the session, one recovery attempt that fell short, and a close right on the pivot at 77.49, which is the market telling you it could not decide anything today. The number that matters above is the ceiling, and it is the densest one on the board. The record high from a week ago at 77.98, the primary call resistance line at 7,800, and the computed second pivot all sit inside 6 points of one another. Above 7,800, dealer positioning flips to negative, and a clean break stops being absorbed. Underneath, the map is just as clear. 7720 decides the character of every session right now. Hold above it, and dealer hedging keeps absorbing movement. Lose it on an hourly close, and the same hedging amplifies instead. Beneath sits the 7,700 shelf. Then the 7680 risk pivot. Watch two numbers into tomorrow, and only two. 7720 below, and the 7800 wall above. The loudest single-name conviction of the day was a stock refusing to break underweight that usually breaks stocks. On Monday, Intel announced a $20 billion share sale at $95, the sort of supply that normally caps a name for weeks. Instead, the stock held 95 to the dollar and rallied 3% today, closing back above its $100 gamma concentration strike on positive flow. The part that makes it a bet rather than a bounce is the position sitting above it. Traders are carrying a 63,000 contract long call line at the 120 strike, which is the objective the options market has drawn for this stock. On a day the index jumped and gave it back, one company absorbed a real dilution overhang and cleared its own line, and the paper above it says somebody expects it to keep going. One more reading before the desk, because it is the setup for tomorrow. Volatility is not just low, it is lopsided. 1-month volatility rank sits near the bottom of its year, while the skew rank, the premium the market pays for downside over upside, sits near the very top. In plain terms, insurance is cheap in absolute price, and expensive only relative to calls, and the 1-month downside puts are the cheapest they have been all year. That is why sophisticated money spent today adding longer-dated put spreads rather than chasing the index. When the calmest, cheapest protection of the season is sitting directly in front of a second inflation number and a policy symposium at the end of the month, the move is to own the cover, not to sell it. The desk read a chop day for what it was and kept its footprint small. 2 looks, both single-leg long calls with risk bounded by the premium and no stop to be hunted. The first was a reclaim long off the opening pullback, and it was booked for a small gain. The second was a later reclaim attempt, and when the hedging flow flipped decisively against it, we cut it at even. A structural exit off a real change in the flow rather than a flinch at a red number. 1 win, 1 scratch, no losses, and the book closed flat. On a day whose whole character was a market that could not commit, the right posture was to take the look the level offered, respect the flow when it turned, and carry nothing into a second inflation print. Flat into the number is exactly where we want to be. Before I lay out tomorrow, I owe you a grade on last night's call because this desk marks its own work in public. 24 hours ago from this chair, the read was a market wowed tight below its record with the inflation print dead ahead, the 7,700 shelf as the level to defend, the 7,800 wall as the cap, and no case for chasing it. Here is how it aged. The number landed benign. The shelf never even came under pressure, and price held comfortably above it all day. But the market did not convert the good news into a reclaim and a run. It spiked and faded and settled on its pivot, which is the ceiling proving itself by turning the day back 30 points beneath it. Now the map. Tomorrow at 8:30, the second half of the inflation pair lands, producer prices, and watch the core monthly line, because it is the only piece forecast to speed up rather than slow down. Producer inflation is running about 150 points hotter than the consumer number, which is a squeeze on company margins more than a fresh consumer scare, and a rate hike dissenter speaks 15 minutes ahead of it. Reclaim about 77.72, and the 7,800 ceiling comes into play, with the volatility tailwind still pushing gently higher. Lose 77.20 on an hourly close, and the same conditions turn against you, towards 7,703 and then 76.80. And if the core monthly producer number prints above 0.4%, the right move is to stand down and let it settle. Anyone who tells you the direction tonight is guessing, and there are no entries before 9:45 once that number redraws the board. A couple of places worth your time, and one room to know about before you go. The Algo Index Trading Journal is free for anyone to open, over at members.algoindex.com/auth/signup. And it grades each setup you record against the exact price your screen was showing the instant you pulled the trigger. If you want to check how the dealer levels we call every night actually played out, held or broke, that ledger stays public at algoindex.com/tools/gamma level accuracy. Tonight's full written wrap is up at algoindex.com/blog. And the people who pull these numbers apart live through the session gather on Discord. Get some rest, keep the 8:30 producer number circled for the morning, and I will meet you back here once it is printed.